All right, good afternoon. Welcome to another live recap. Let's start with just quickly reviewing the trade plan and context heading into the open. So our directional bias was neutral across the board today, which means that all the weight goes into the real-time intraday bias. So we didn't have any larger time frame force, essentially, very dominant in the market just yet, at least at the time of publishing the morning trade plan. And really, the market could have tipped in either direction. What we did know is that we had a key high volume node at 29.28.5, which is nothing new. It has been an important HVN for at least a couple of weeks now. The 32 quarter to 37 quarter area, if you look back a couple of weeks, it's been a important and larger time frame area of resistance for at least 2 or 3 weeks now. We have continued to see sellers active there. So on the upside, that was the main inflection point. If we got a breakout above that area, that would set the intraday bias to bullish. And since the others are all neutral, then our focus would be purely on the long side, and we would exercise caution on shorts. And in the event that we got a failure at the initial resistance or the 28.5 HVN, then we could break down or head lower at least into 1475 to 1675. A break below that would serve as a bearish indication, at least short term. Then we had support at 05.5 to 08, 2900.5 to 03, and finally down at 89 to 93, where buyers could be active. And whether we went long at any of those zones would depend on the real-time intraday bias. So with the directional bias being neutral across the board, again, all that weight gets shifted to the real-time intraday bias, which means that we're not going to have just resting orders at the support or resistance zones, but we are going to have to interpret the real-time information more closely and then make that decision of, hey, do we buy, do we not buy, right? So that was the context heading into the open. Now let's jump into the chart, see how it played out. So in this case, we can see that the directional move really begins in the overnight session off of that 2850 high volume node. So I've mentioned this many times on Twitter. If you follow me there, I'm pretty sure I've covered it in prior videos as well, that these key high volume nodes can often serve as launching points of directional movement or directional conviction. So that's what we were seeing here, and the move just happened to begin in the overnight session, which is not a big deal. Like, that doesn't change or affect the principle. These moves can happen at any point in time. So the move starts in the pre-market session. The market is going directional off of that 28.5 HVN. We get a move down into the initial support zone. Sellers are looking more dominant anyway. And then off the open, it's simply a continuation of that launch from the 2850 level, and we get a move down into the next area of support. Now, in terms of trading this move to the downside, there are a couple of ways to do that. You can see that off the open, the internals are heading lower, tick is below zero, and we know that a break below initial support is a bearish indication. So one method is to short the actual breakdown itself as it's breaking down. So that's a breakdown setup. The other option, and this might be a little bit more comfortable for most traders, is to short the pullback. So instead of getting on board the move, which I think requires a pretty aggressive mindset and swift execution, the easier thing to do is that once you see that breakdown take shape, so now we have that short-term bearish confirmation, then look for the pullback. This can be a 38% retracement type idea. So for example, if we look at just this move, you can see we get this roughly 38% retracement over here. Also have the RTH VWAP not really a major point, but you're looking for a spot to get on board. So around 12 half, 13, stop around 15 half, 16, looking for a test of the next area of support with the idea that, maybe we even go lower. Now, as you're looking at the RTH chart and, just the price action off the open, don't lose sight of the bigger pattern. This move started at 28.50, right? So by the time it comes all the way back down into that support at 05 half, it's quite overdone. So even though our trade off the open might have gotten us in around 12, don't lose sight of the fact that the pattern actually started around 28.50, 29, right? It didn't start over here, it started up over here. So by the time it gets down to 05 half, it's pretty overdone to the downside, and there can be a buy response that happens here. So, now it's your choice. Do you want to just take the position off, short 12, out 05 half? Do you want to scale out? I think it's a pretty prudent thing to at least reduce some risk at the 05 half level, knowing that it is a valid area of support. So you can take kind of the balanced approach. We don't know if it's going to go lower, could go lower, and it could go even down 93. So there is enough reward potential to justify a holding part of your position. But at the same time, the move started at 28.50. And that's what a lot of trading decisions come down to. It comes down to kind of weighing these things, weighing these observations, and then making good enough decisions. It's not about making perfect decisions. It's not about getting the best entry, best exit. Good enough is all good. It's good enough. So if you're out at 05 half, or if you're taking partial at 05 half, that's fine. Now what happens after that is interesting, because we get this bounce back up over here, which doesn't seem like a big deal in and of itself in the S&P. But if you're watching the other markets, you'll notice that we saw a much more notable bounce in the Russell. So, in this case, for example, you can see that ES bounces back towards the RTH, VWAP, and mid. Well, the Russell bounced back up to the 24-hour session VWAP and mid. So that would be like the S&P at the time bouncing back up into this area over here. So back up towards, 16 to 18. So that's kind of the equivalent bounce that the Russell was putting in as ES put in this little retracement. And that was interesting because the market's trading below the previous day's low. In order for these markets to continue heading lower in any significant way, we essentially need to see trend down or liquidation type conditions. We need a particular environment for that move to take place. And this was simply not shaping up to be that environment. Number one, you can see we're not getting really any big downward momentum over here, right? So in the early session, tick is below zero, no major downside values, but it's below zero, good enough. Over here, we're not really getting that downward momentum anymore. The Russell is putting in a pretty significant bounce back up, and keep in mind that the Russell is the weaker market. So if the weaker market has managed to put in such a strong bounce, then what does it say about the stronger markets like the S&P, right? That can also put in a better upward bounce. There could be kind of a little momentum shift in the works here. And this is stuff that I posted about on Twitter if you follow me there, that hey, we're getting some buying here in the Russell. Russell's catching a bid, and if it starts taking out its mid and VWAP, then we could get some better movement in the S&P as well. Now, there are a couple of ways to trade that observation. One is that when the market pulls back into the support zone, if you're still holding short, use that as an opportunity to get out of the short side, because the real-time environment is not indicating a big liquidation move at this point in time. And as day traders, we have to be very mindful of timing. It doesn't help us if the market goes lower the next day or later in the afternoon. The trade has to work now. So you have to be in the now moment. And there needs to be a balance of understanding the trade plan, the bigger context, the environment across a larger time frame, but then also being very mindful of what's happening here and now. Because as day traders, the trade it's going to work either in the next 10, 15 minutes or it's going to get stopped out in the next 10, 15 minutes. The time horizon is typically pretty short for intraday trades. They either work relatively soon. There's some trades, of course, in lower volatility environments that can take hours and hours to play out. But majority of trades, they're either going to work in 10, 15 minutes or they're not going to work in 10, 15 minutes. That being said, I don't have any rules around a time stop. I've been asked that before, do you have a time stop? I don't. It's all based on the environment that I'm trading in. So in this case, as the market comes down, at the very minimum, it's a good idea to cover if you're holding short. The next level decision would be to actually reverse your position, or if you're flat, initiate a long trade with your stop loss a tick or so below 0.4 quarter. So over here you can see that the market comes down and the swing low is 575 or something. And if you're putting your stop at 0.4 and you're buying 0.7, right? That's only a 3-point stop. It does not take a whole lot to get 2-to-1 risk reward out of it, or even more. So ideally, this is a long opportunity, right? And again, you don't have to trade it exactly that way, but the observations are meant to help you see these patterns so you can apply these things over and over again. It's not just about today, right? Any of these recaps, they're not just about today. These are repetitive patterns. And when you see a similar situation, I'm hoping that these ideas click in your mind and help you make better decisions in real time. Because it's not just about, what happened today. Let's look at what the, trade setups were. It's about how we can use that knowledge and pattern recognition and rules and processes and principles to help improve our trading and real-time decision making going forward. So the market comes down here, we are out of shorts and we are entering long. And then as the market bounces back up, knowing that the sellers are dominant below initial support, it is a good idea to scale out. Now that scale out could be at 2R, it doesn't have to be at 1R. You don't have to get out for just 3 points if you're using a 3-point stop. Take a 2R scale out because resistance is all the way up here. It's not going to take a whole lot to get a move from 7 to 13, for example. So a scale out is not a bad idea in this situation because things are a bit mixed. Now, once you've reduced some risk, now it gets a lot easier to hold the remainder of the position for a better upside move. And the final upside target on this is going to be the previous close, the previous VPOC, up in the 23.75 to 24 quarter area over here. So ideally, you're holding at least some of your trade into the 23.24 area, or somewhere around 20. It doesn't have to be exactly 23.24, but somewhere in that area would provide a very good exit. Now, if we look at the short-term price pattern over here, we can see that the swing low for this move is down here at roughly 9. So by the time the market gets up into 24, well, now it's overdone to the upside. Just like earlier, the market got overdone to the downside and buyer stepped in. Well, now the market's overdone to the upside and we have that 2850 HVN overhead. We have that pretty decent resistance overhead. So what do you think the traders who bought this pullback or this dip, anywhere in this area, what do you think they're going to do when the market's hitting 24 and at the same time we start to kind of lose that steam and that momentum over here, right? Well, they're probably going to take profit. There's probably going to be some selling, some profit taking that comes into the market based on this breakout. So if we look at, this intraday balance, which looks, roughly something like this, right? And this was just an open drive lower, so we don't have to measure it all the way up here. Really, majority of the price action is contained within this range, right? So if we look at that, we can see that the 100% extension of this balance is up near 25. So the market's getting very close to the 100% range extension of this intraday balance, which can be used as a profit target. We have the previous close, the previous VPOC up there. The market's now short-term exhausted back into it. So this group is likely to take profit. Now, what about the group from the overnight session? All right, so let's expand the 5-minute chart here. So what about the group that bought all of this, right? As soon as this breakdown happens, this group, and even the group from yesterday, is going to be, at the very minimum, probably in a nervous position, right? Imagine, put yourself in the same shoes. Let's say you were long from 28 or 28.50, right? Because that's where the HVN is. That's where the overnight VPOC is. So let's assume you're long from 28, and let's assume you're still holding your trade. You see the thing break down below yesterday's low. You get a bounce back up. It's very close to your entry price. What are you going to do? What do you typically do when you're in a bad trade and the market now comes back close to your entry and lets you out for a very small loss? Well, you're probably going to sell as well. So that's looking at the market through the lens of market participants. And it's not a science. It's just an educated guess. It's putting yourself in the position of buyers and sellers and trying to make good enough decisions. Again, it's not about perfection. So this group is probably going to want out. This group is going to want out. We're hitting the previous close in VPOC. The other markets are now also exhausted to the upside. The Russell is now struggling at its 24-hour midpoint, so it never really kind of gained any real steam. NASDAQ is testing its overnight VPOC and testing some resistance from the overnight session, which is closer to, testing the 28 area in the S&P. So the more likely scenario is that there's going to be more selling or more aggressive selling than more aggressive buying. Because keep in mind that in order for this move to continue, buyers have to continue buying and lifting the offers at these higher prices, right? We need to see sustained upside momentum. So on the 1-minute chart, we are seeing upward momentum, right? But that's what got you here. This momentum is what got you here. But now you're going to need to continue to see that momentum, and continuous buying at the offer is going to be needed. So that means we need to see continuous, not just bidding, but aggressive buying. Lifting of offers is what moves the price up, not sitting at the bid. And that's unlikely. When you put all the pieces together the way that I've just kind of done here, that's unlikely. So at the very minimum, it's a good idea to get out of any longs that you may be holding by the time the market gets to 24. At the same time, a short setup can be considered there with your stop loss back at 28.50 or 29, right? So it is going to require 4.5 or 5-point stop, but that's where the stop should be if you're going to take the trade. And if that stop's too wide, if you think the target's not going to be enough, then fine, skip the trade. Don't have to catch every possible swing and turn in the market. From there, we get a push down into the mid and the earlier intraday balance breakout area, right? So we get this pullback into the RTH mid, coincides with the breakout spot, so probably going to get some level of buying over there as well. So pretty normal. So in the event that you shorted, the expectation is for buyers to step in here. Good spot to cover and scale out and take some profit. After that, the Russell continues to get weaker and weaker. The S&P is holding up short term, and then we get an intraday balance breakdown. And remember that with our bias being neutral across the board, all of the weight is now being given to this real-time intraday stuff. And that's why on days like this, you really have to be on top of the intraday price action and pattern development and all the stuff that's happening in real time. You have to be even extra aware of that, because that is what's getting all the weight, because the other time frames are neutral. They're not really exerting any big force. So intraday gets all the weight. So in this case, we balance a little bit at that breakout spot, and eventually we get an intraday balance breakdown pattern. That provides us with a shorting opportunity. That can be done on the breakdown itself or, just like earlier, on the pullback, right? So that's what I want to convey here, is that these patterns are repetitive and these principles can be applied over and over again. A principle would be pretty useless if it were only applied once and then you never saw that scenario play out again. The whole benefit of having these principles, rules, guidelines is that they happen every day or they happen frequently enough that we can continue using them. So in this case you can see again, right? Swing over here, that's the breakdown, 38 to 50% retracement area, bottom of the intraday balance, that's now resistance. Sellers active over there, that presents us with a shorting opportunity. So you don't have to short the breakdown itself, you can short the retracement, just like earlier, right? Same pattern again. And then on the downside, same thing. Market gets overdone into the RTH low, into support, good spot to take profit. And as the market is coming down there, we're seeing a positive divergence on the advanced decline. So you can see that earlier in the morning, the AD was down near minus 1,000. And now when we come back down to the lows, it's a little bit away from that minus 1,000. So we have that positive AD divergence, which is why it's a good idea to cover and take profit. And I think some members even use that as a long area around 05, using a 2.5 point stop, looking for a quick 2R bounce. Not a trade I personally was very interested in, given how the day had developed, but it is a valid setup. And one idea I've discussed in the past is that when it comes to divergences, the first one is really the one that matters. And after that, if the market still shows weakness in terms of price action, then ignore the divergence, right? It's the first time that a divergence shows up, that's when it makes a difference. If after that there's no follow through in price action, then forget about the divergence, give weight to price action. And that's what we see over here, where technically there's a divergence even at the end of day, right? But given the time of day, we know it's a risky time to fade the market, and now it's second or third test of that area, and the divergence doesn't matter. It only matters the first time. So eventually we end up getting a breakdown into the closing range, and then in the Globex session, we've already seen a test of the next area of support down at 93, right? So we've already seen this, a test of 93 where buyer stepped in and pushed the market back up towards 2,900. Broken support acting as resistance. So buyers active here. This was the spot where in the morning video I talked about how there is a high probability of buyers stepping in. It's a pretty decent area of support, and now we saw a pretty, nice little bounce. Nothing major so far, but nice reaction off that 93. And I think that's going to be an important area of support in the overnight session. And if we stabilize here in the overnight session, then there is still potential for balancing in this recent range. And if you take out 89 to 93 on the downside, then it just becomes yet another bearish confirmation, and eventually we could just stair step our way down and test the support areas below, and eventually make our way back down into 67 to 70 and whatnot. So right now our directional view is going to remain neutral on the short term. The intermediate term is like neutral, maybe neutral bearish, since we did get that pretty nice response off the 2850 HVN. But now heading into overnight, how ES responds to the 89 to 93 zone, and on the upside, how it responds to the 03 to 05 area is going to be important. So if on the upside we can start trading back above 03 to 05, 2903 to 05, then that would signal some short-term stability. But right now, the smaller pattern that's in play here is still bearish. So, market broke down below the day's low in the closing range, went down to the next zone. Some buying there is expected. So this is not telling us anything just yet. This is just a reaction. But then on the upside, if we can take out the 03 to 05, start trading back into today's first hour range, then it would be a positive sign for buyers. But if we continue trading below 03 to 05 and continue balancing, below 2900, then it would be a negative signal for buyers, and it would be good for sellers or shorts because it could lead to a breakdown below 89 to 93, and a break below that area would confirm the sell side in control. All right, guys, so that is a wrap for today. Hope you guys found the extended recap helpful, and hope you guys can put these ideas and principles into practice. Typically, I'll cover a couple of questions, so if you guys have any questions, we can take one or two since we're already like 26 minutes into the recap here. Zach's question is, what time span do you use for the opening range? Is it usually the first 5 minutes? So it's not purely based on time. It's really more based on allowing that opening balance, or the opening 2 to 5 minutes to develop. Sometimes it's very clear within the first 2-3 minutes what the opening range is. Other times I may adjust the opening range even after the first 5 minutes if I notice some new development. A good example of that is yesterday, I believe. So let me just kind of expand that here. So yesterday, if you look at this, just clean up the chart here, take the stuff off so we just have a clean price chart. So you can see yesterday that we get an upside move at 23.25. The opening range high is pretty clear at 26, but then we get this move down to 22.5, and then a move right back up into the opening range high. So initially I had the opening range drawn as 23.25 to 26. But then when I saw this, sharp move back up, I adjusted the opening range to be 22.5 to 26. So I hope that kind of just shows you that, there is some flexibility here. It's not a super rigid approach. But I will say that on most days, the first 5 minute range, like as a general guideline or rule of thumb, if you want to simplify it, the first 5 minute range will usually encompass the opening range. So if you want to keep it simple and not have to kind of go through and make all these other adjustments and tweaks and whatnot, then you could just use the first 5 minute range. Because in this case, you can see that the reaction is not at 23.25, it's actually earlier, right? The whole purpose of this is to identify some real-time support resistance and help us figure out kind of which side is being more dominant off the open. So, if we left the opening range as 23.25 to 26, then, this response wouldn't make as much sense. But if we adjust the opening range to 22.5 to 26, then we can use this level, and it's useful, it's actionable. All right, so the next question is thoughts on the long setup at 1040. Yeah, I think it's okay. It's valid. It's not the best setup by any means. There are opportunities earlier, but it's a breakout retest setup. It is a valid idea. Right over here, right? So buying this retest is basically a breakout retest idea over here. And it also coincides with the initial support zone, so you have a little bit more going for you there. So it's valid, but I would be cautious with it in the sense that if you're buying there, then you may want to just get out either by the first hour high or maybe scale out by the first hour high, but I would manage that trade pretty closely if I'm going to take it, because if that breakout retest is going to work, then I need to see upward momentum coming back in the market. And you can see that we never got that, right? So if you're taking it long on the retest here around 14.15 or whatever, then you want to see the tick character changing to look more like this. And if that's not happening, then probably not the best trade to be in. So it's okay to enter, not the greatest trade to continue holding. Rob's saying, what is the significance of the opening range versus the first hour range? It's a similar concept and principle, just on a much smaller time frame, right? So like we don't want to wait an hour to allow the first hour range to get established, and then we make some decisions based on that. I mean, the opening range is just a way to know on the very small time frame, very early in the session, which side is being more dominant. The opening range is not actionable every day. It is contextual, so we're not going to act on the opening range every single day. There are certain times when it just doesn't make sense to even trade the opening range in terms of actually taking a trade in terms of a breakout or breakdown of it. Yesterday was a good example. It was kind of a choppy area. I wasn't looking to trade it. So, but it's very smaller time frame, support resistance, gives us a good idea of which side is being more dominant. If we are anticipating, let's say, a directional move and the market doesn't pull back into a zone, because quite often when the market's going directional, it will not pull back into a good spot. In those situations, the opening range can be helpful because it gives us a way to execute a directional trade that may already be in play by the time the market opens. So, it is a really interesting concept. I think it's very useful, but not to be used every single day. Nothing exists in a vacuum. Zach's question, is it valid to take a short on the breakdown of initial support today? Yeah, I think it's valid because today we were ready for directional movement. The market was primed for it. So yeah, and the break below that area is a signal of weakness. Dave's saying, on days when you mention there are times to be aggressive, does that mention with regard to position size versus a day like today where some traders are not as skilled as reading the intraday price action and size down in contracts? So no, I don't vary position size. I would rather just not take the trade. So, when I say that there are certain days where they're better suited to more skilled traders, I'm not saying size down, although, I mean, if you want to do that, that's one approach. You may just want to watch from the sidelines if you're relatively new or if you're still kind of learning, or just increase your selectivity. It doesn't always mean, just don't trade at all. It just means wait for some clarity, wait for maybe better location. Just be a little more careful, you know? So either of those would be fine. It's not kind of a one size fits all, but in terms of position sizing, I'm not really a fan of adjusting position sizing in terms of like, we're going to be aggressive today, conservative, because I think that can really mess up your results in the long run. It's one more decision to make, right? Like, okay, do I take full size? Do I take half size? And I think that, most of us are just not equipped to make that decision correctly, consistently over time. So my recommendation is to be very systematic and almost robotic when it comes to position size. Don't mess with it because you could have a winning methodology and you could really screw it up by screwing up the position size. Position sizing is critical, super, super important. I think newer traders don't even realize how big of a deal it is to get the position size right and to follow a process and a systematic approach. So I personally, I wouldn't mess with position size. Watch my webinar on risk management, how we do position sizing, and just stick with that. This whole idea of like, this trade I feel really good about, so I'm going to size up. This one I don't, or it's a slippery slope. And I just don't see most traders. I mean, I've seen professional traders mess that up so much that I don't think developing traders or retail traders really have a shot at getting that right. I mean, I've worked with some, pros, seasoned pros, who were having trouble in their trading because their position sizing was just very unstructured, and it was resulting in, big drawdowns. And yeah, so don't mess with position sizing. Stick with the spreadsheet and be robotic, systematic, automatic with that. Like, don't mess with it. That would be my suggestion. All right, guys, so that is a wrap in terms of the questions. Thank you for all of you who were able to attend. And of course, no big deal if you can't. It is going to be recorded and it'll be up on the site shortly. So thanks again. Hope you guys traded well today. And we'll catch up again tomorrow morning. Take care. Good night.